You don't lose money because you draw trend lines. You lose money because you believe the line is the reason price moves, and that belief is dangerous. Trend lines feel clean, structured, and convincing enough to build confidence. First, the lows are connected, then the line is extended. A support zone gets marked, and the bounce is anticipated. And when price respects it, it feels like confirmation. It feels like proof that you understood the market. But here's the part nobody talks about. Trend lines work perfectly in hindsight, because in hindsight, you already know which swing mattered, you already know which wick to ignore, or you already know which touch was valid. Backtesting makes interpretation look objective. Live trading exposes that it isn't. In live trading, the candle is still forming. The pullback is not confirmed. The trend has not proven itself. The line you draw is not structure, it's expectation. And expectation feels like confidence until it doesn't. Here is the real flaw. There is always another way to draw it. The anchor point can shift. The slope can change. A wick can be included. A wick can be ignored. Two traders can look at the same chart and produce two completely different trend lines. Both will believe they are correct. If a tool changes depending on who draws it, it is not objective. And anything that is not objective becomes unstable under pressure. This is why backtests feel powerful, because once the move is finished, the correct line becomes obvious. But in live trading, you do not know which version is correct. You are drawing in uncertainty. And uncertainty mixed with interpretation creates emotional decision-making. That is where the trap begins. Now let's see what actually happens in real time. The trend is established. Higher highs, higher lows, momentum is strong. The trend line has already been respected multiple times. Confidence builds with every touch. A pullback begins. Price approaches the trend line. It enters the support zone. This is where most traders feel aligned with the market. The bounce starts. A bullish candle forms. Volume increases slightly. Everything looks consistent with continuation. Entries are taken. Stops are placed just below the zone. Risk feels controlled. Confidence rises quickly, and the more confident traders become, the less they feel the need to question the setup. Then something subtle happens. The bounce is weaker than the previous ones. Momentum does not expand the way it did before. The next candle fails to create a strong, higher high, but bias overrides observation because the line is still there. Then the breakdown begins. Not violently at first, just enough to test conviction. Price pushes slightly below the trend line. Many traders tell themselves it is a fake break. The zone is still valid, the structure is still intact, but the selling pressure increases. Stops begin to cluster. Liquidity builds under the zone. Once that liquidity is sufficient, price accelerates through the level. The trend line that felt like protection becomes the trap. The zone that felt like support becomes the liquidity pool. This is not random. This is not manipulation in a dramatic sense. This is simply how participation works. Retail sees continuation. Structure sees completion. Retail sees support. The market sees resting stops. The reversal feels sudden, but structurally, it was developing long before the line was broken. The problem is not that the trend line failed. The problem is that the line prevented you from seeing the shift in behavior, because the drawing became the focus instead of the sequence. And that is how the trap completes. Now remove the drawing. No trend line, no zone, no interpretation. Look at the same chart again, but this time ask a different question. Why did the reversal happen? Markets move because orders need to be matched. And for a large move to happen, liquidity must exist on the other side. When the majority of traders follow the same rules, use the same trend lines, and place stops under the same zones, they create predictable liquidity. The more confident the crowd becomes, the more concentrated that liquidity becomes. Adjusting the line slightly does not change this. Drawing it cleaner does not change this. Because the problem is not precision, the problem is participation. When enough traders are positioned the same way, the market has incentive to move against that majority. Not to punish them, but to access their orders. That is why the breakdown occurs. Not because the line failed, but because liquidity was generated. Now this is where the approach changes. Instead of asking where price should bounce, we define direction first, we define where liquidity is likely resting, and we define whether the move is expanding or completing. When direction is defined, you stop reacting to drawings, you start reading positioning. Same chart, different lens, one focuses on shapes, the other focuses on order flow behavior. That difference is what removes guessing and prepares you for the next step. Before we move forward, take 1 second to like this video and subscribe for more content like this. It really helps the channel grow and allows me to keep exposing this type of structure for you. Alright, let's jump right back into it. Now let's simplify this. Instead of drawing lines ourselves, we let price draw the reference for us. A moving average is not placed by opinion, it is calculated from price. It moves because price moves, it shifts because participation shifts. There are no anchor points to choose, no slopes to adjust, no decisions about which wick matters. The reference updates automatically. That alone removes subjectivity, because the line is not drawn by us. It is drawn by price behavior. When price expands too far from its average, it shows imbalance. When price compresses around its average, it shows balance. No interpretation is required, only observation. Now look at the same example again. Overlay the moving average. Notice how price was already extended. Notice how the pullback was not strength, but a return toward average conditions. The reversal did not begin at the trend line. It began when expansion was complete. The moving average did not predict the move. It exposed the condition of the move, and that is the difference. One tool tries to predict reactions, the other measures position. When the reference is mechanical, your decisions become mechanical, not emotional, not interpretative, defined, and that is how we approach the market. Now, let's take the exact same example, but this time remove the random average and replace it with DMA. Price stays the same, structure stays the same. We only change the lens. Watch what happens. In this example, price pulls back into what looks like a trend line. A trend line trader would prepare for a continuation because the structure appears stretched. But look at DMA. Price is still positioned correctly relative to direction. The pullback is not an overextension, it is a controlled return. Momentum is not fading, it is stabilizing. This is not completion. This is liquidity building. The key difference is simple. The trend line reacts to touches. DMA evaluates position. If price is expanding in the correct direction and returning in balance, continuation is still valid. No guessing is required, no redraw is required. The structure either aligns or it does not. And you did not need to draw anything to see it. You only needed a consistent reference. DMA does not predict, it clarifies. It tells you whether expansion still has room or whether it is already stretched. That clarity changes the decision, not emotionally, structurally. Now you understand why I don't draw trend lines or zones in Forex trading. Not because they never work, but because they depend on interpretation. And interpretation creates inconsistency. Hopefully this helped you see the market from a different angle. If it did, apply it, test it, observe it in real time, and see how much of what you believed was structure actually was just an expectation. If this breakdown brought clarity, please leave a like and drop a comment. Let me know what part changed your perspective, and subscribe because there are more retail traps I'm going to expose next. And if you're serious about transforming your trading into a no-drawing, no-guessing mechanical structure, check the link in the description. Join the community, study the framework, and build your process the right way. Thank you for watching. I'll see you in the next one.